Welcome to Pinnacle Tax Advisory Business Owner Workshops, a series of proven strategies that will save you tens of thousands of dollars every year in taxes. Half of American taxpayers use third-party professionals to complete their tax returns, yet, according to the U.S. Treasury Department, 85% of us overpay. Welcome to Pinnacle Tax Advisory Business Owner Workshops, a series of proven strategies that will save you tens of thousands of dollars every year in taxes. Half of American taxpayers use third-party professionals to complete their tax returns, yet, according to the U.S. Treasury Department, 85% of us overpay. Are you satisfied with the taxes you pay? Are you confident you are taking advantage of every available tax loophole or deduction? Is your tax advisor giving you proactive advice on how to save on taxes? Chances are you do pay too much in taxes. The good news is you don't have to. You just need a better plan. In this series, we're going to talk about some of the biggest mistakes that business owners make, then how to solve them. Let me introduce our company. We are Pinnacle Tax Advisory. We have been helping clients put together proven tax strategies and preparing their taxes for almost a decade. We have clients throughout the downtown Brighton, Michigan. Please visit us at our website or check out our blog, checkyourtaxes.com. Now, the number one mistake business owners make is, you guessed it, they fail to plan. The IRS code is full of tax deductions for the small business owner. With proactive tax planning, you can make smarter and loftier choices. What would you have changed if you knew you could completely write off your kids' braces and added a swimming pool to your own backyard? So exactly what is tax planning? Tax coaching is about giving you a plan to minimize your taxes. What should you do? When should you do it? How should you do it? Tax planning gives you two powerful advantages. First, it's the key to your financial defenses. As a business owner, you have two ways to put in your pocket. Financial offense is making more. Financial defense is spending less. For most of us, taxes are our biggest expense. So it makes sense to focus our financial defense where we spend the most. Second, tax planning guarantees results. You can spend all sorts of time, effort, and money promoting or you can set up a medical expense reimbursement plan, deduct your daughter's braces, and guarantee savings. Most common question we hear is, doesn't my CPA do that for me now? Or, I'm sure my CPA would tell me where I can save on taxes, wouldn't he? It's his job, right? Producing tax returns or months are very different disciplines than delivering strategic tax blueprints to minimize tax obligations while reducing the likelihood of an audit. Let's start by taking a quick look at how the tax system works. This will lay a foundation for understanding the specific strategies we'll be talking about soon. The process starts with income, and this includes most of what you'd think the IRS is interested in. Earned income from wages, salaries, bonuses, and commissions, profits and losses from your own business, interest and dividends from bank accounts, stocks, bonds, and mutual funds, capital gains from property sales, pensions, IRAs, annuity income, alimony, and gambling winning. Even illegal income is taxable. The IRS doesn't care how you make it, they just want their share. The good news is, if you're operating an illegal business, you can deduct the same expenses if you're running a legitimate business. If you're a bookie, you could deduct the cost you used to take bets. Once you've added up total income, it's time to start subtracting adjustments to income. These are a group of special deductions listed on the first page of the Form 1040 that you can take whether you itemize deductions or not. Total income minus adjustments take whether you itemize deductions or not. Total income minus adjustments to income equals adjusted gross income, or AGI. Adjustments to income are also called above-the-line deductions because you take them above AGI. Adjustments include IRA contributions, moving expenses, half your self-employment tax, self-employment health insurance, self-employed retirement plan contributions, alimony you pay, and student loan interest. Once you've determined adjusted gross income, you can take a standard deduction or itemized deductions, whichever is greater. $400 for joint filers and $6,200 each for married couples filing separately. Tax deductions reduce your taxable income. If you're in the 15% bracket, an extra dollar of deductions cuts your tax by 15 cents. If you're in the 35% bracket, the same extra dollar of deductions cuts your tax by 35 cents. You can also deduct a personal exemption of $39.50 for yourself, your spouse, and any dependents. Once you've subtracted deductions and personal exemptions, you'll have taxable income. At that point, the table of tax brackets, you may also owe self-employment tax, which replaces Social Security and Medicare for sole proprietors, partnerships, and LLCs. You'll also owe state and local income tax as well as earning taxes. Some types of income aren't taxed at the regular rate. For example, tax on qualified corporate dividends and long-term regular rate. For example, tax on qualified corporate dividends and long-term capital gains is capped at 20%. There's also a 3.8% unearned income Medicare contribution on investment income for single taxers and joint filing earning more than $250,000. For purposes of this new rule, investment income includes interest, dividends, capital gains, rental income, royalties, and annuity distributions. Oh, and don't forget that your itemized deductions and personal exemptions start phasing out once your income hits certain levels. For 2014, those are $254,000 for singles and $305,000 for joint filers. The bottom line here is that tax brackets aren't as simple as they might appear. Your actual tax rate can be quite a bit higher. Finally, you'll subtract any tax credits. These are dollar-for-dollar tax reductions regardless of your tax bracket. So if you're in the 15% bracket, a dollar's worth of tax credit cuts your tax by $1 full. If you're in the 35% bracket, an extra dollar's worth of tax credit cuts your tax other than knowing they're out there. Ultimately, there are two kinds of dollars in this world: pre-tax dollars and after-tax dollars. Pre-tax dollars are great, and after-tax dollars aren't bad, but they're not as good as pre-tax dollars. So here's the bottom line. You lose every time you spend after-tax dollars. That could have been pre-tax dollars. Let me repeat that. You lose every time you spend after-tax dollars. That could have been pre-tax dollars. We're going to spend the rest of this presentation talking about dollars. We're going to spend the rest of this presentation talking about how to turn after-tax dollars into pre-tax dollars. We're going to use three primary strategies. First, earn as much non-taxable income as possible. Second, make the most of adjustments to income, deductions, and credits. There's really no magic to knowing what's available. Finally, shifting income to later years or lower bracket taxpayers. This includes making the most of tax-deferred retirement plans and shifting income to lower bracket children, grandchildren, and family members. The second big mistake is nearly as important as the first, and that's fearing rather than respecting the IRS. What does the kind of tax planning we're talking about do to your odds of being audited? The truth is, most experts say it pays to be aggressive. That's because overall audit odds are so low that most legitimate deductions aren't likely to wave red flags. Audit rates are actually at historic lows. For 2012, the overall audit rate was just 1 in every 100 returns. The IRS primarily targets small businesses, especially sole proprietorships and created laundromats, with opportunities to hide income and skim profits. In fact, they publish a series of audit guides that you can download from their website that tell you exactly what they're looking for when they audit you. Take a look at the bottom of the chart. You'll see that the IRS audits just 0.5% of corps and partnerships. If you're already worried about being audited, you might consider reorganizing your business to help fly under the radar. The next mistake is choosing the wrong business entity. Most business owners start as the sole proprietors, then, as they grow, establish a limited liability company or corporation to help protect them from business liability. But choosing the right business entity involves all sorts of tax considerations as well. And many business owners are operating with entities that may have been appropriate when they were established, but just don't work as effectively now. I can't make you an expert in business entities, but I do want to walk through one popular choice to illustrate how important this question can be. If you operate your business as a sole proprietorship or a single member LLC taxed as a sole proprietorship, you may pay as much in self-employment tax as you do in income tax. If that's the case, you might consider setting up an S corporation to reduce that tax. If you're taxed as a sole proprietor, you'll report your net income on Schedule C. You'll pay tax of whatever your personal rate is, but you'll also pay self-employment 15.3% on your first $117,000 of net self-employment income and 2.9% of anything above that. Starting in 2013, you'll also pay a new 0.9% surtax on anything above $200,000 if you're single and $250,000 if you're married, filing and $250,000 if you're married, filing jointly, or $125,000 in income if you're married, filing separately. Let's say your profit at the end of the year is $80,000. You'll pay regular taxes at your regular rate, whatever that is. You'll also pay about $11,000 in self-employment tax and Medicare tax that your employer would have paid and withhold if you weren't self-employed. How many of you plan to retire on Social Security? An S corporation is a special corporation that's taxed like a partnership. The corporation pays you a reasonable wage for the work you do. You pay the tax on that income on your own return. So the S corporation splits the owner's income into two parts, wages and pass-through distributions. Here's why the S corp is so attractive. You'll pay the same 15.3% tax on your wages as you would on your self-employment income. But there's no wages as you would on your self-employment income. But there's no Social Security or self-employment tax due on the dividend pass-through. Let's say your S corporation earns the same $80,000 as your proprietorship. If you pay yourself $40,000 in wages, you'll pay about $6,000, but you'll avoid employment tax on the income distribution, and that saves you $5,184 in employment tax you would have paid without the S corporation. Now let's talk about the fourth mistake, choosing the wrong retirement plan. If you're looking to save more than $5,500 limit for IRAs, you will have three main choices: simplified employment pensions or SEPs, simple IRAs, or 401ks. I'm not here to make you an expert on retirement plans, but I can help you decide pretty quickly if the plan you have is right for you or suited for your specific needs. So bear with me, even if the next few slides look intimidating. These are some very powerful strategies. The SEP is the easiest plan to set up because it's just a turbocharged IRA. If you're self-employed, you can contribute up to 25% of your net incorporated, and you're salaried, you can contribute 25% of your covered compensation, which is roughly the same as your salary. The maximum contribution for 2014 is $52,000. If you've got employees, you'll have to contribute for them too. You generally have to contribute the same percentage for your employees, as you do for yourself. However, you can use what's called an integrated formula to make extra contributions for higher incomes. The money goes straight into the employee IRA accounts. There's no annual administration or paperwork required. The SEP is easy to maintain and flexible. If there's no money to contribute, you just don't contribute. But the contribution is limited to a percentage of your income. If you set up an S corporation to limit self-employment tax, you'll also limit your SEP contribution. The next step up the retirement ladder is the simple IRA. This is another turbocharged IRA that lets you contribute more than the usual $5,500 limit. You and your employees can contribute up to $12,000. If you're 50 and older, you can make that extra $2,500 catch-up contribution. If your income is under $48,000, that may be more than you could sock away with a SEP. That's because $12,000 is more than 25% of whatever you could contribute to a SEP. But you have to match everyone's deferral or make profit sharing contributions. You can match everyone's contribution dollar for dollar up to 3% of their pay, or contribute 2% of everyone's pay whether they defer or not. If you choose the match, you can reduce it as low as 1% for 2 years out of the 5. The money goes straight into employee IRAs. You can designate a single financial institution to hold the money, or let the employees choose. Like the SEP, there's no setup charge or annual administration fee. The simple IRA may be the best for part-time and sideline businesses earning less than $48,000. You can also hire your spouse or children, and they can make simple contributions. We'll be talking more about those strategies in a few minutes. It's the 401k. Most people think of 401ks as retirements for bigger businesses, but you can set up what's called a solo or individual 401k just for yourself. The 401k is a true qualified plan. This means you'll set up a trust, adopt a written plan agreement, and choose a trustee. But the 401k will be far more money, far more flexibility than either the SEP or the simple. You and your employees can defer 100% of your income up to $17,500. If you're 50 or older, you can make an extra $5,500 catch-up contribution. You can choose to match your employees' contributions or make profit-sharing contributions up to 25% of their pay. That's the same percentage you can in your SEP, or top of the $17,500 deferral. The maximum contribution for $2,000 per person plus any catch-up contributions. You can offer yourself and your employees loans, hardship withdrawals, and all the bells and whistles the big boys offer their employees. 401ks are generally more difficult to administer. They are anti-discrimination rules, or what's known as top-heavy rules. Anti-discrimination rules, or what's known as top-heavy rules, to keep you from stuffing your own account while you stiff your employees. There are safe harbor 401ks available, but we'll cover that in another series. If you operate your business by yourself, you can establish an individual 401k with less red tape. And again, you can establish an individual 401k with less red tape. And again, you can hire your spouse and contribute to their account. If you're older and you want to contribute more than $52,000 limit for SEPs or 401ks, consider a traditional defined benefit pension plan. Defined benefit plans let you guarantee up to $200 and deduct as much as you need to finance that benefit. You'll calculate those contributions according to your age, your desired retirement age, your current income, and various actuarial factors. A 412I plan, which is funded entirely with life insurance or annuities, lets you contribute even more. You can combine a defined benefit plan with a 401k or SEP to give yourself a little more flexibility. Now let's talk about the fifth mistake, missing family employment. Hiring your children and grandchildren can be a great way to cut taxes on your income by shifting it to someone else who pays less. Yes, there's a minimum age to someone else who pays less. Yes, there's a minimum age. They have to be at least 7 years old. Their first $6,200 of earned income is taxed at zero. That's because it's the standard deduction for a single taxpayer, even if you claim them as your dependent. Their next $9,075 is taxed at 10%. So you have to pay them a reasonable wage for the service they perform. The tax court says a reasonable wage is what you'd pay a commercial vendor for the same service, with an adjustment made for the child's age and experience. So if your 12-year-old son cuts grass for your rental properties, pay him what a landscaping service might charge. If your 15-year-old helps you keep your books, service might charge. If your 15-year-old helps you keep your books, pay him a bit less than a bookkeeping service might charge. Does anyone have a teenager who helps you with your website? What would a commercial designer do for that service? To audit-proof your return, write out a job description and keep a timesheet. Pay by check so you can deposit the check into an account in the child's name. But it doesn't have to be his pizza and Nintendo fund. It could be a Roth IRA for decades of tax-free growth. It could be a Section 529 college savings plan. Or it could be a custodial account that you control until they are 21. Now you can't use money. Now you can't use money in a custodial account for your obligations of parental support, but private and parochial school aren't obligations of parental support. Sleepaway summer camp isn't an obligation of parental support. So let's say your teenage daughter wants to spend 2 weeks at horse camp. You can earn the fee yourself and pay for camp with after-tax dollars. Or you can pay her to work in your business, deposit the check in her custodial account, and then, as custodian, stroke the check to the camp. Hiring your daughter effectively lets you deduct her camp as a business expense. If you hire your child to work in an Social Security until they turn 18, so this really is tax-free money. You'll have to issue them a W-2 at the end of the year, but this is painless compared to the tax you'll waste if you don't take advantage of this strategy. Now let's talk about healthcare costs. Surveys used to show that taxes used to be small business owners' biggest concern. Now it's rising healthcare costs. If you pay for your own health insurance, you can deduct it as an adjustment to income on page 1 of Form 1040. If you itemize deductions, you can deduct unreimbursed medical and dental expenses on Schedule A if they total more than 10% of your adjusted gross income. But most of us don't spend that much. What if there was a way to write off medical bills as business expenses? There is. It's called Medical Expense Reimbursement Plan, or a Section 105 plan. This is an employee benefit plan, which means it requires an employee. If you operate your business as a sole proprietorship, partnership, LLC, or S Corp, you're considered self-employed. So if you're married, hire your spouse. If you're not married, you could do this with a C Corp, but you don't have to be incorporated. You could do it as a sole proprietor or LLC by hiring your spouse. You could do it as a sole proprietor or LLC by hiring your spouse. The one exception is the S Corp. If you own more than 2% of the stock, you and your spouse are both considered self-employed for purposes of this rule. You'll need to use another source of income, not tax as an S Corp, as the basis for this plan. Let's assume you're a sole proprietor and you've hired your husband. The plan lets you reimburse your employee for all medical and dental expenses he incurs for himself, his spouse, which covers you, and his dependents. This includes all the expenses you see listed here: major medical insurance, long-term coverage, Medicare and disability treatments, and special schools for learning disabled children. It even covers non-prescription medications when prescribed by a physician, vitamins and herbal supplements, and medical supplies. The best part is, this is money you would spend anyway, whether you get a deduction or not. Whether you get a deduction or not. You're just moving it from a non-deductible place on your return to a deductible place. You'd need a written plan document, which we can provide for you. You'll need to track your expenses under the plan, which we can also help with. Required, you'll report reimbursements as employee benefits on Schedule C, Form 1065, or Form 1120. You'll save income tax and self-employment tax. There's no pre-funding required. You don't have to open a special account like the medical savings account of flexible spending accounts. You don't have to decide You don't have to decide how much to contribute, and there's no use it or lose it rule. It's just an accounting device that lets you characterize your family medical bills as business expenses. You can reimburse your employee or pay health care providers directly. Let's say your husband needs to pick up a prescription or pay health care providers directly. Let's say your husband needs to pick up a prescription. He can use his own money, or you can reimburse him. Or he can use a business credit card and charge it to the business directly. If you have a non-family employee, you have to include them too. You can exclude employees under 25 who have worked for you less than 3 years. You can also exclude employees covered by a collective bargaining agreement. Non-family employees may make it too expensive to reimburse everyone as generously as you've covered your own family. But if you're offering health insurance, you can still use Section 105 plan to cut your employee benefit and using a Section 105 plan to replace those lost benefits. If a medical expense reimbursement plan isn't appropriate, consider the new health savings accounts. These arrangements combine a high deductible health plan with a tax-free savings account to cover unreimbursed costs. To qualify, you'll need a high deductible health plan with a deductible of at least $1,250 for single coverage or $2,500 for family coverage. Neither you nor your spouse can be covered by a non-high deductible health plan or Medicare. The plan can't provide care benefits until the deductible for that year is satisfied. You're not eligible if you're covered by a separate plan or rider offering prescription drug benefits before the minimal annual deductible is satisfied. Once you've established your eligibility, you can open a deductible savings account. You can contribute up to $3,300 for singles and $6,600 for families. You can use it for most kids of health insurance, including COBRA continuation and long-term care premiums. You can also use it for the same sort of expenses as Section 105 plan. The health savings account isn't as part of the 105 plan. You've got specific dollar contribution limits and there's no self-employment tax advantage, but health savings accounts can still cut your overall health care costs. The home office deduction is probably the most misunderstood deduction in the entire tax code. For years, taxpayers feared it, raised an automatic audit flag, but Congress has relaxed the rules, so now it's far less likely to attract attention. Your home office qualifies as your principal place of business if you use it exclusively and regularly for administrative or management activities of your trade or business. And you have no other fixed location where you can conduct substantial administrative or management activities of your trade or business. This is true even if you have another office. So long as you don't use it more, you have to use your office regularly and exclusively for business. Regularly generally means 10 to 12 hours per week. To prove your deduction, keep a log and take photos to record your business use. You can claim a workshop, studio, or separately identifiable space you use to store products. If you use it more than one business, both have to qualify to take the deduction. Once you've qualified, you can start deducting expenses. If your tax is a proprietor, you'll use Form 8829. If your tax is a partnership or corporation, there is no separate form. Which helps you fly under the radar. First, you'll need to determine business use percentage of your home. You can divide the number of rooms if they're roughly equal, or calculate the exact percentage of square foot. And you can exclude common areas like halls and stairs to boost that business use percentage. Next, you'll deduct your business use percentage of rent, mortgage interest, and property taxes. You'll depreciate the business use of your home's basis, excluding land, over 39 years as non-resident. Finally, you'll deduct your business use of percentage of utilities, repairs, insurance, garbage pickup, and security. If business use percentage for specific expenses differs from business use percentage from the overall home, such as high electric bills for home office equipment, you can claim the difference as direct expenses. Claiming home office can also boost your car and truck deductions. That's because it eliminates non-deductible commuting miles for that business. You can use home office expenses to shelter profits, but not below zero. If your home can carry forward those excess losses for future years. When you sell your home, you'll have to recapture any depreciation you claimed and could have claimed after May 6, 1997. You can still claim the $500,000 tax-free exclusion from home office space. If this all seems like too much work, there's a new safe harbor method that lets you claim $5 per square foot up to 300 square foot of qualifying home office. However, using the safe harbor method might not let you claim nearly as much as the traditional method. We can help walk you through the calculations to see which method is best for you. Now let's talk about car and truck expenses. I don't want to take too much time here. but I do want to point out the most common mistake clients make with these expenses. The deduction of 56 cents a mile for business, what they drive or where they drive. Now, do you think we all spend the same to operate our cars? It might surprise you just to see how much it really costs to operate your car, and it's not exactly 56 cents a mile. Every year, AAA publishes a vehicle operating cost survey. Costs vary according to how much and where you drive. But if you're taking the standard deduction for a car that costs more than 56 cents a mile, you're losing money every time you turn the key. If you're taking the standard deduction now, you can switch to the actual expense method if you own your car, but not if you lease. You can't switch from actual expenses to the mileage allowance if you've taken accelerated depreciation. By the way, the same rules apply for the standard deduction of 23 medical expenses, as well as 14 cents a mile deduction while being in service for a charitable organization. Let's finish up with some fun deductions for meals and entertainment. The basic rule is that you can deduct costs for meals with a bona fide business purpose. This means clients, prospects, referral sources, and business colleagues eat with someone who's not a client, prospect, referral source, or business colleague. If you're in a business like real estate, insurance, or investments where you're marketing yourself, the answer might be never. Be as aggressive as you can with what you define as bona fide business discussion. The general rule is you can deduct 50% of your meals and entertainment. The IRS knows you have to eat, so you can't deduct it all, but they'll meet you halfway. How many of you entertainment at home? Do you ever discuss business? Are you deducting those meals too? There's no requirement that you eat out. Don't forget to deduct home entertainment expenses too. You could deduct entertainment expenses if they take place directly before or after substantial bona fide discussion directly related to the active conduct of your business. You can deduct the face value of tickets to sporting and theatrical events, food and beverages, parking, taxes, and tips. Now, you don't need to keep receipts for expenses under $75, but you do need to record the 5 pieces of information listed in your business records. You should try to record this information daily if possible. The IRS just wants to know the cost of the meal, when and where it took place, the business purpose of your meal, as well as your business relationship with your guest. Now that you see how business owners miss out on tax break, let's talk about the biggest mistake of all, assuming. As a business owner, you hire accountants and CPAs to do your bookkeeping, payroll, human resources, and to file your taxes on time. There is an underlying assumption that as they perform their duties, they would be looking for ways to save you money in taxes. Unfortunately, this is not normally the case. Accountants and CPAs focus their time on GAAP methods and compliance, while a certified tax coach is disciplined in researching and validating specific strategies that lower tax obligations within the guidelines of the IRS code. These elite tax professionals network, communicate, and collaborate to bring best strategies for you, the business owner. So what you get when you're hiring a tax strategist and how to do it. You complete a questionnaire about your current revenue and expenses, projections, and goals. Review your last 3 years' tax returns to find savings that may have been overlooked, and a written tax plan that addresses your family, home, job, your business, and your investments. We would like to invite you to experience the value with not just 1, but 2 free, no-obligation tax strategy sessions. The first 30 minutes, we will review your business entity choices, profit and loss statements, financial statements, balance sheets, and trial balances. We will look at the last 3 tax years for missed opportunities. The second meeting is a broad overview of the tax plan, where we identify potential areas for tax savings for past, present, and future tax years. If we agree that we can save you a considerable amount of time and money in taxes, then we will then forge a consulting relationship. One of the best parts of working with a certified tax strategist is by giving a 100% refund guarantee to our tax minimization blueprint. If we have not given you a proven legal and ethically sound strategy to considerably minimize your taxes, we will refund 100% of your tax blueprint consulting fee. Meetings can be held over the internet through JoinMe. A conference call, or a face-to-face. You owe it to yourself to see just how much we can save you in taxes. Call us today to schedule your tax minimization strategy session. Pinnacle Tax Advisory is principals and